key developments for markets this week was at the meeting of the European Central Bank, where we saw or heard further details of their bond buying programme. The key factors to this bond buying programme is that it's going to be targeted at the shorter end duration of the yield curve. And what that means, to all intents and purposes, is that for coupon for bonds issued with an up to 3-year life expectancy, they can buy these bonds, and they have unlimited resources to be able to, in effect, manipulate those yields lower down to make it more acceptable, and for these countries such as Spain and Italy that have very significant requirements for refinancing over the course of the next 18 months. Now, the question, of course, in this is that are these countries going to move to an entirety of refinancing on very short-dated paper? It's akin, effectively, to somebody moving off of a term loan or a mortgage onto an overdraft facility, where every 2 or 3 years you're going to have to come back to the market and refinance, and that does pose a number of risks for a sovereign, and you certainly wouldn't want to refinance your entire debt over that sort of short duration. So the key is this going to endear enough confidence into the markets at the shorter end of the curve for those that want to participate at the longer end? And the key to that, as we'll see in a minute, is looking at the charts of, say, 10-year Spain and Italy debt. If we can see yields come down there, that will reflect confidence from private participators that the actions the ECB taken are significant and will avoid defaults in these particular countries. So let's just take a look at some of these charts. Let's start with the 10-year Spanish, and that move there in yields, you may recall that where it got sort of into dangerous levels during the summer months, up above 7%. As we stand here on Friday, that yield is back down now to 5.7%. That's an encouraging development, in my opinion. It reflects what I would want to see off the back of the ECB announcement is some money coming in for longer dated debt, because remember, this is not a bond that is expected to be covered by the ECB, but it's by the ECB actions at the shorter end. If we can see further progress on these yields, maybe sub 5%, heading towards 4% over the course of the next few weeks, which is quite an aggressive call, then clearly that will certainly in the near term have resolved some of those sort of very short-term stresses on European markets. So if we take a look at the Italian situation, very much similar picture there, and as you can see, this is really the move that has been seen over the course of the last few weeks. So I think with this backdrop, there is room for a little bit of risk-on speculation for equity markets, possibly to move higher on the back of this data. And what we have seen in the course of this week is that money is coming into some of those risk assets. Probably the most correlated class that has moved into risk-on type trading is the European currency. Here we see the European currency versus the US dollar, and really since Draghi's comments were made towards the end of July and the promises that he made, and as I say, details revealed, we've seen a move in the euro dollar from approaching 120 up now to 127. I've mentioned many times that this is a very aggressively shorted currency. Many hedge funds have been negative on the euro for some while now about the potential risks in the euro, and of course as these moves have sort of countered that in the very near term, we are seeing a sort of quite a squeeze move higher in the euro at the moment. It's not helpful, obviously, for the euro to get too strong. A lot of these countries do need to start to broaden their export base away from internalised European demand and start focusing on growth areas like Europe. A competitive currency would be clearly attractive, so we wouldn't want to see that euro rise too far without that potentially causing some concern to the currency. Some other classes that I'd mention here, we've got the gold price. It's worth mentioning that obviously whatever actions taken both in Europe with bond buying programs, and indeed thoughts turning to QE3 in the US, particularly on the back of a non-farm payroll number that came out just a few moments ago that came in below expectations. They've flagged up that QE3 is on its way. So all of the stimulus that is taking place around the world the thought turns to, is this going to turn into an inflationary stimulus? Well, I think at the moment it's not perceived to be that much of a risk, but some early money going into gold as a potential hedge against inflation at the moment. So you can see how that chart has been moving quite sharply higher during the course of those previous comments. Just want to mention a couple of others. I mentioned or update on a couple of others. I mentioned last week about the mining stocks, how they had been hitting new lows, but that these stocks could turn in the event that Draghi would deliver and take some of the stresses out of the European system and put some stimulus back into the market. Well, it's interesting. This is Rio Tinto. It's bounced over 10% in the space of 48 hours since that ECB decision. So just always keep miners in mind for the more active traders. So in conclusion, I think in the near term, I think the actions that have been taken by the European Central Bank will be sufficient to reduce some of the stresses that have been seen in the system and some of the stresses that in fairness have been weighing on stock markets for a while. So I can see a period where markets can continue to rally on the back of this news. It doesn't resolve in any way the longer term issues that Europe has with declining economies and the austerity moves that will be required as part of the conditions of this bond buying programme. And if you start to think about that through over the course of a longer period of time, I think there are some very worrying signs about that. But I think in the near term, as I say, some of the risks have been removed from this market, the short-term risks, and in that environment I can see equities potentially moving up during the course of the rest of the third quarter.